Well, thanks for tuning in to BloombergQuint. A lot of conversations that we have about indices, about where they are moving, are with market experts. It's rare that you hear from the head honcho of one of the largest benchmarks, if you will, come and talk about not really what will happen to the markets. I mean, that's a conversation that we have regularly, but about what's going on within the indices, what's going on in the world, what's happening in terms of conversations that the large business makers and market makers are having with the people who matter. And that's the kind of guest that we have for you today. He needs no introduction, but let me still tell you, it's Alex Matturri of S&P. Thanks so much, Alex, for joining in today. It's a pleasure having you on BloombergQuint.
Thank you for having me today.
Yeah. Now, I was reading up some of the recent interviews that you've done. One that I believe you had with Financial Times. And you had a quote which said that those pennies from ETFs add up. And that shows, at least to my mind, that shows that you do believe that the way going forward for at least the developed markets, if not the emerging markets, and please correct me if I'm wrong, is through passive funds versus active funds. Now, whether they are in the forms of ETFs or otherwise is a separate thing.
Right, yeah, and that's a big driver of our business, certainly has been this, what some are calling a mega trend of actively managed portfolios moving to more passively managed portfolios. So it's been going on actually for quite a while. It's not really a new trend, although I would say in the last year or two it's been getting a lot of attention. And it's a big part of our business because as an index provider, there's really two things that we provide to the marketplace. One are indices that are used to measure benchmarks, measure markets. But secondly, indices that are used as the basis for investment products.
Yes.
ETFs are one of those types of products, as are index funds, traded futures, and other asset classes.
Yeah. Now, and I agree with you. I mean, this is probably not a new phenomenon, but Alex, for a large portion of viewers who are Indian and investors who are in India, this has now started to pick up steam. Maybe because Warren Buffett mentioned it in his meeting and the whole reference to John Bogle and those books selling off. But also the fact that there are some people in India who are now starting to say this, that if not now in the next few years, maybe active fund management will get dwarfed in comparison to passive fund management because the returns will start looking identical. My question to you is, having looked at maybe the histories of a lot of developed economies and how those indices have moved and how active versus passive has moved there, do you think India as a market is already ready for leapfrogging to passive fund managements via ETFs, via that your partners will be providing, or is it some time away?
I think it's still early days here. I think that trend is definitely here, but it's still very early. If you look at markets that are more sophisticated in terms of the education of investors, where people understand what drives investment performance. As many people know, we publish these SPIVA reports. And what they've done is bring some clarity to the marketplace. They've brought information about performance of managers as a whole. Now what these SPIVA reports, what they don't say is that you can't find good active managers. They absolutely exist out there. But what they do show that is over longer periods of time, it's hard to find the manager that can consistently beat their benchmark. And you see it in many different markets across the world where we publish these SPIVA reports. Here in India, the most recent report I think showed that about 50% of managers were not able to outperform their benchmark.
Okay.
So if 50% haven't, that means 50% were able to outperform. But I think the trend is going to be the same that we've seen in other markets, and it's because there's some structural changes that have been taking place. Number one, I think people are becoming more aware of what's going on in their portfolios. They understand performance, what's driving that performance. When fees are high, that impacts portfolio performance. And when returns are low and fees are high, that gap is widened. Clearly, when you're measuring against an index, there is no fees associated. But even if you looked at index funds, I think generally you'll see the same trend that over time active managers will underperform their index funds too. So I think that a lot of this is driven to market efficiency. Technology has made information so widely available that it becomes hard to get an edge as an active manager.
Yeah.
You think you know something about a company. Well, go on the internet. Everybody else knows that same thing about the company. And as quickly as information is made available, technology spreads it across the globe. So there's, I think, some fundamental changes that have taken place. And why would India be any different? It's coming from a smaller base. Clearly, active management and stock picking is still very traditional here. But I think over time that trend will definitely change.
But you reckon what, 5-10 years out, or maybe early?
That's hard. I don't want to be held to a time frame, but we're starting to see in terms of new index products coming to market.
Yes.
ETFs. We have about 15 ETFs here in the marketplace.
Wow.
That may seem like a lot. In the U.S., that's tiny. There's 15 new ETFs maybe launched in a week in the U.S.
Wow.
But I think it has to start somewhere.
Sure.
Even in the U.S., ETFs are just a way of gaining index exposure. They started in I think 1989 was the first ETF launched, or 90 in the U.S. It took time for the market to develop in the U.S., and that's a pretty sophisticated, large market.
Sure.
Even there, the amount of assets that are managed to index strategies are still relatively small compared to active. So they're capturing more and more of the flows, right? So the flows have been coming out of active products, going into passive products, but there's still a long ways to go. We see this trend globally, and so I would think, in India, as investors become more sophisticated, as people start to understand more about their portfolios, I think you're going to see people turn more and more to index-based type investment products.
What's your view on India? I mean, one, from a perspective of the business prospects that it holds for you, for that matter, and two, just the investor interest that could be in India for the foreseeable future with all that's happening.
Well, I think, so two parts to that answer. I think we're very bullish on India when we look at emerging markets in general. We see those as places where we want to participate in. You look at the big emerging markets, China, there's always political issues around how the capital markets operate. Brazil, another potentially good growth story. Again, a lot of political issues around the marketplace there, very resource dominated. So when you look at India, Korea, is it really emerging markets or a developed market? That's a separate question. But you look at the prospects here in India, you have a population that's becoming wealthier, clearly coming off of a small base, but becoming wealthier. They're going to invest more. You have a government that trying to free up the markets, trying to open up and get more economic growth. That means more money eventually will find its way into the marketplaces for people to invest. That's not going to happen overnight, but I think there's positive steps there. You have generally a pro-capitalist type society, and that's a good place to be in. I think our role is to help educate and bring transparency to the marketplace. So I think there's still a lot of work to be done, but the trends are positive.
Yeah, and what would that portend? And I'll actually want to dwell a bit more on what you, you would have conversations with so many business leaders and maybe even market makers over in the world. I want some data on that as well. But just before that, what does all of this mean for business for a company like yours? Because as you said, there is a lot of work that needs to be done in order to educate and bring transparency.
Yeah, so I think there's multiple players that need to participate in helping grow the markets. Clearly, the exchanges provide the infrastructure. The product issuers have to issue the products.
Yes.
We're not a product issuer. Our role is to help bring indices to the marketplace that allow investors to understand more about their markets, to understand and become more transparent, that allow people to develop products based on it. So I think those are the places that's the role that we have to play in. So we can bring more and more indices. I think we have about 40 indices here in India now. Globally, we calculate 1 million indices every night. So there's no shortage of index ideas that we can't bring into the marketplace.
I'm sure.
But when the market is ready for it. You don't want to just bring an index and launch it just for the sake of launching it. Our philosophy is to do things from a local market perspective, which is why we like partnering with an exchange like the BSE. They help us open doors into the local marketplace. We have a big presence here, close to 60 employees in India. So we want to build a business from the ground up rather than take a global index and just say India is a slice of our global index.
Yeah.
That's not the right approach for local investors. You need to take into account what are their perspectives of the market, what interests them. We can't drive economic growth, but if we understand what's going on in the marketplace and what investor preferences are like, we can help bring the right indices into the marketplace. Things like ESGs, things like smart beta or factor-based indices are all newer concepts to the market here. But they're concepts that have worked in other markets and we think will work here.
Okay, so I want to talk about that as well. But firstly, just a thought from you. The conversations that we have had with a bunch of foreign fund managers too over the last 1.5 odd months, and if we indeed look at the fund flow situation in India to the last 2.5 odd months, foreign institutional investors have pulled out money and pulled out quite a bit of money. Where do you think India is in terms of investor interest? Could this be a valuation-led pullout and availability of other options, if you have some thoughts here? And do you think that international investor interest in India over the course of the next 4 or 5 years, irrespective of what happens on the political front, would be sustained?
So I'm not an economist, so we don't forecast or look closely at things like fund flows.
Sure.
What I would say is that I think generally, post the U.S. election, you first saw a big flow into U.S.-based underlying products, right? So people put money into the U.S. marketplace because they expected President Trump to change economic policies in the U.S. And there's still a lot of discussion about how effective that is going in Washington.
Sure.
But U.S. markets have been strong. They're up, 15% this year. It's still very strong performance. It hasn't given much back. Phase 2 was a growth of money moving into emerging markets and international, non-dollar-based assets when the dollar peaked earlier in the year. So India, I think, gained there, as did Brazil, as did Asia and emerging markets generally. So I think that's about the level that I look at it at.
Sure.
I don't look at particular countries, but I look at the performance of India, and it's been quite strong. And we've got an economy that's still growing, north of 6%. That's pretty healthy. There's not a lot of places that you can get that in the world right now. I mean, even the U.S. is just over 3%, I think now, right? That's as strong as you've seen in a long time.
Yes.
So I think on a relative basis, it's still an attractive market. But again, I think that's really more the domain of the fund managers who know how their customers' flows are going.
Yeah, I agree. But okay, maybe you have a top-down view on what some of the macro events could do to develop markets versus emerging markets. If I can quiz you on that, two things. One, both the ECB and the Fed going into what, well, a lot of people would say historic moves, historic retreats, if you will. And there is always this lurking danger of North Korea. What do you think these events, they're chalk and cheese, but what do you think these events could do to investor interest, forget the fund flows, but investor interest into DMs versus EMs?
Look, North Korea, if there's, God forbid there's ever bombs flying overhead, that's not good for markets by any means.
But it's not happening. Do you think the markets are shrugging it off?
It's interesting. I was in Seoul, Korea not too long ago. And, even with all the rhetoric globally, business is booming in Korea. They have a different perspective. Now, they've lived with North Korea, I think it's 30 miles from Seoul to the North Korean border. So one argument would say, if they're going to do something, they could have done it a long time ago. Hopefully it's just a lot of posturing, but again, it's a risk, and any type of risk is not good for marketplaces. In terms of kind of this end of quantitative easing, Fed raising rates, again, that's a risk. I'm not an economist, but if it's telegraphed properly, the Fed's been telegraphing that rates are going up in the U.S. and the markets have held up. That's hopefully the sweet spot, and it continues. But if they overshoot, if people don't anticipate something, sure, markets could get hit with that. But those are short-term factors.
Short-term factors. Long-term, you think EMs and India, by and large, look healthy enough for investor interest and for business?
They're growing faster than the rest of the world, right? And at the end of the day, what drives equity markets and valuations is economic growth.
Yeah, true. And that seems to be on a good mend. I think some of the reforms that have been done also are probably helping all of that. Some other questions. What's also picked up, on BloombergQuint we do a show called the Mutual Fund Show, and out there, the fund managers are divided over what's, at least to my mind, a very recent phenomenon in India, TRI. Now, what's your view here on total return index? Do you think it could actually usher in something that is much needed, or your views differ?
I don't have much of a view on a TRI. I mean, I think that's something maybe for our local team to answer. Okay,
fair call. We'll leave that out. The other thing that, if you have a view on, is that there is the Securities and Exchange Bureau of India has a proposal, if you will, to increase market timings in India. What do you think that does? I mean, does that place an emerging market like India more in line with what some of the other global markets do as well? Because it stays open for a longer period of time, and probably at times when some of the developed markets start trading. Does it help? Is there, to your view, is it beneficial?
So I think markets that stay open and give people broader choice in terms of timing of trades certainly doesn't hurt. What you do, though, is still need to have liquidity in the marketplace. You see it with markets that trade, some markets, some U.S. equities, some trade 24 hours a day.
Yeah.
Most of the trading is going to follow the local market liquidity, though. Sure. But giving access to investors, broader access, I think that's a net positive.
Okay. Now, in one of your answers earlier, Alex, you did mention about ESG. It's a factor that is now starting to come up in conversations, but India hasn't really embraced it in a big way. I mean, aside of one or two or three companies, we don't really see stock premium being paid to companies which have got a high economic and social governance. Do you think that, has there been past instances of emerging markets or otherwise which didn't embrace it fully, but eventually it became a really big component of conversation and investing in those economies?
I would say even developed markets. In the US, it's still a conversation more and more. But still a lot of people have not accepted it.
Okay.
I think the key to ESG is, I think initially everybody was looking at ESG investing as a way of generating additional return. Companies that were sustainable should generate more return because they're more efficient in what they do. And I think there's an argument to be had there. But more and more, I think ESG needs to be thought of from a risk standpoint. You've got climate change policies coming. Whether you agree or disagree on global warming, governments are changing their policies. Governments are mandating disclosures. And within that means that there's risks in portfolios. If you think about, you have a portfolio that has, a few years ago had coal mining companies in the U.S. And all of a sudden government policy comes in and says, we're going to de-emphasize coal mining. As an investor, that's a risk to you. You want to know what companies are related to that. It may not be just companies that are direct coal miners, but say you have a company that manufactures something that you sell to coal industry. So I think you have to think of, if you start thinking of some of these ESG factors as a risk, it puts it in a different light because it gives you that transparency and understanding of what drives a company in light of changes that may likely happen because of policy changes. And I think as an investor, you want to know what is the impact of these policy changes. In some areas like Europe, they're being mandated. Companies and pension funds are being forced to disclose what's the carbon output of the companies that I hold in my portfolio, and that'll lead to them having to reduce their weightings in their portfolios because they want them to invest in cleaner companies. So that has a direct economic impact. So there, ESG, again, you think about it from a risk standpoint, it's very, very different than, does it make me feel good, which was the original kind of view of ESG. And I think a lot more is going to be more around this concept of risk. I don't think it's just a developed versus emerging market phenomenon. In fact, in our travels, we see a lot more of emerging markets talking about it because they want their companies to be viewed at global standards. So we work with a lot of stock exchanges that want us to help develop ESG indices for them because they want global investors to come in and invest in a company knowing that they meet kind of the global standards. So it opens up different avenues for investment. Interestingly, the U.S. is still further behind than Europe. Europe is much more advanced. There's not a customer you speak to in Europe that doesn't want to incorporate or has not incorporated ESG in some form in their investment portfolios. It hasn't transformed into investment products the same. You don't see a lot of ESG ETFs yet, for example, or index funds. I think that'll happen. But it is impacting portfolios themselves and the way people look at stocks.
Just since you mentioned it, you reckon that if not as investment product, then as something, as you said, that impacts portfolios, this phenomenon could get ushered into EMs. I don't know about India specifically, but emerging markets or developing markets, let me put it that way, a lot quicker than what people are anticipating right now? Well,
I think because oftentimes in the emerging markets, some changes happen faster than they happen in developed markets.
Oh, yeah.
And I think, if you're, as an Indian company, just hypothetically,
sure,
you want foreign investors to buy your stock, right? Well, if you want European investors, you better have some ESG analysis of your company, because that's gonna be part of their investment decision. Sure. Again, that may not be the same thing for a U.S.-based investor yet. That's just a matter of time, though.
Okay. My final question, really, last couple of questions. There is an interaction that you did recently. I'm quoting something out there, and I want you to elaborate and maybe explain this. You mentioned that the S&P 500 trades in every sphere. It showcases a model that countries like India, and you mentioned a few other countries, but I'm just using India as an example here. You said that it showcases a model that countries like India can follow to build thriving capital markets and promote financial growth. Can you elaborate a bit on this?
So the S&P 500, clearly people understand that as a US-based index, but it does trade through either ETFs, through futures that are available in other marketplaces. Investors could access it in these markets, and it's become what I think is the first 24-hour traded index. And I think it shows that how important that is to help drive economic growth, because when people think of the U.S. markets, they think of something like the S&P 500. But it's also led to the development of many different types of investment products tied to that, that bring liquidity to the marketplace. And so, in a lot of countries, by working with the local markets, working with the local exchange, in our mind, when investors think of investing in India, we want them to think about the Sensex. Whether it trades here, whether it trades, through some, ETF in the U.S. that brings liquidity back to the local marketplace because it is a local index. That's what I meant by that. That's a model that we could be followed in other marketplaces. That the local index can trade outside of the local marketplace, but still bring liquidity back because again, it's based on stocks that trade here in Mumbai.
How large and how quick could acceptability of such a product be for a market like India?
Well, I think that's it will take some time. Clearly, I mean the S&P 500 has been around for over 70 years.
Of course,
it is the largest index in the largest U.S. equity capital market. So clearly, that's the extreme. But I think more and more the use of indices across markets are becoming global. In ways that people could access them through technology is going to become easier and easier. There shouldn't be a problem why, subject to government regulation and capital controls and things like that, an investor here can't sit on their iPhone in a Starbucks and trade ETFs, right? 24 hours a day. Actually, it actually probably does happen already. But I think that's the way capital markets are going. And I think the key is to make sure that these sort of products don't drain liquidity from the local marketplace. And that's why we like to work with the exchanges, to develop indices and make sure that liquidity stays here and bring foreign investors into the local marketplace also. What you don't want to have happen is, trading in Indian stocks that take place offshore. The government can't regulate it, doesn't benefit the local markets, doesn't help local liquidity. Looking at it from a local perspective, I think is really the direction you want to go.
Oh, that's a very interesting thought. And it's a very interesting conversation, quite different from what I usually have with Alex Matturri. Thank you so much for taking the time out and speaking to us on BloombergQuint. It's been a pleasure having you.
Thank you for having me.
And viewers, thank you so much for tuning in.